You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates, and happy Monday, August 31st, 2020. We've done it. We've gone through another month, and that also means in the coming days, we're going to see TREB stats for Toronto real estate. Today, we got a wonderful lineup. Thank you for tuning in. We are the largest, fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts, and we have a ton of fun. So today, we got a great lineup. We're going to start off discussing rental prices for this month, August. Are they up? Are they down? Or maybe are they a little bit of both? We're going to discuss what that looks like and how do Toronto condos compare with the rest of our country. It's going to really put into perspective how well or how poorly our condo market is doing when we compare it with the rest of the country. And as we're speaking about Canada, we're going to transition into this idea of our dependence on real estate, discussing this idea of GDP versus how influenced is our GDP compared to real estate. Is real estate a big part of it? Is there a problem brewing where maybe we're getting a little too comfortable with our real estate assets? We're going to discuss all of these wonderful things. Make sure you give us a subscribe, give us a like, leave us a comment. Tell your grandma to subscribe, and we're having a lot of fun. And every now and again, I get a comment, which today is definitely worth sharing, from Ryan Reiner on YouTube. Thanks, man, for your comment. It just brightened my day, which is why I'm going to share it with you guys. If anything, it's the gloat, but it just goes to show you the type of family we've been able to develop on our channel over the last few months. Here's what he says. This is such a strategic piece of daily news for me. I have other podcasts, but none I listen to daily. I appreciate your ability to see beyond the data and color it with the agendas of all the actors in the real estate ecosystem. It's like a trip through the real estate jungle, and you are the local guide. I also love your sense of levity and your boldness to state your faith. Thank you. Thank you, Ryan. Thank you for your comments. And thank you to all of you. I know behind this, there's many other comments and messages I get from you guys. And I also love when people just send me questions for themselves, just kind of asking for help. I'm here to help you guys. I'm here as a resource. And I hope you guys, like Ryan, are getting a lot out of our channel. All right, you guys ready to start rolling here? You know I like to start off with some light news. And today we're going to talk about universities because they made me chuckle. CBC.ca has an article that came out in the last 24 hours. Ontario universities to teach COVID-19 related courses this fall. So they interviewed this teacher, an instructor from OCAD, right? Her name is Sova. And she said this: while I was making collages one day in early April, I realized that our students might also want to make art about this unprecedented time. And it may also benefit from responding creatively. So they're creating a new course called the COVID-19 Responsive Art course. It'll prompt students to look into their own artwork in response to how the pandemic is affecting their personal lives and explore how historical and contemporary artists have responded to similar crises in the past. They've also got another course if you're in law. You got law and politics of COVID. We got politics of pandemics out of McMaster University. My goodness, thank you, universities, for equipping young minds for the workforce. And also, thank you to the student loans for helping fund the $1,000 you need to take pandemic art. How can we ever repay you? Anyways, I think that's hilarious news. That makes me chuckle. Some of the courses that they take, I'll tell you. Some of these courses. But that's how the cookie crumbles. Okay, so let's start getting into real estate. Let's get down and dirty here. Start talking about rental prices. Maybe you're wondering, are rental prices going up or down or both? I think the easy answer is that they're going down, right? Because we've seen that as a trend yearly. We've seen it as a trend monthly. But maybe the times are changing, and maybe rental prices, as I've been calling for the last few weeks, even for the last month, I was shocked it didn't happen last month. We're starting to see a bottom of Toronto rental prices. Here we go. This comes from nowtoronto.com. It is vindication for me saying rental rates are, this is your chance, tenants. Jump in. Well, now the numbers are starting to line up with what we've been saying for weeks. Prices for new rental apartment listings went up in July, but the prices for all property types are down across the GTA. So here's the numbers. Here's how the numbers fall. Year over year, According to TorontoRentals.com, the price for a new rental listing for all property types in the GTA was down in July to 8.7% annually. So when we compare it year over year, as we would expect, because we're not going to have a sudden shock where it flips up again, we have rates down annually 8.7%. Condo owners asked $260 less year over year for units hitting the rental market. That's the tangible. So what is 8.7? I mean, it's just a number. But when you say it's on average $260 less than you were charging this time last year, you realize the impact. But there's this trend that we've been mapping on a month-to-month basis, because really monthly is what counts. Am I going to get more than I was getting last month? Well, now we're starting to see a bottom. They say that average price for rental apartments actually went up monthly 1.7% to $2,065 per month. Is that an amazing number? No, but it's a trend. It's a reversal of the trend that's been going down, and we're starting to see monthly now it's going up. And what we've really been mapping is that the drops have been slowing. That's kind of how I saw this coming. The drops in rental rates have been slowing. They were happening very quickly, and we noticed this pullback. They were still going down, but going down slower, which a lot of people say, oh, it's still going down. Well, but you have to follow the trend, and the trend was what was indicating to us that we were nearing a bottom. And in fact, it seems as though last month was the bottom. I'm not talking August, I'm talking in July, right? Because we're now seeing it coming back up. Now, when we look a little bit more diverse, maybe we're going a little further out, maybe you got a basement apartment, right? Basement apartments have been very volatile over the past year. They've been dipping and rising without any clear pattern. So when we look at the numbers right now for basement apartment rentals, they're actually higher than July 2019, right? Because we're up just under 2%, but for basements, they're actually up 4.6%. Listing prices for basement apartments were the highest they've been during COVID-19's pandemic. Paint that one, baby. Put that in your art. What is it? Roll that in your art and smoke it. Nobody says that anymore. Put that in your pipe and smoke it. That used to be such a big thing. Okay, here we go. I guess it's because everyone's on vapes now. Oh, shut up, Brad. Move on. Okay. The waterfront area, just a fun fact. So if you're near the waterfront, they actually experienced the largest drop. In fact, they're down year over year, 9.4%. So if you're wondering who's getting clobbered, it's the people closest to the water, it's the people closest to the downtown core. Just as a general trend, they seem to have been impacted the most. Well, all of this news comes shortly after an announcement that was just made, and we just announced this on our last podcast. If you missed it, please go back. I thought it was a wonderful podcast. It explains this idea of a rent freeze, and I'm going to add to it here as well. But what we're finding now is that this new plan that's coming, it's not even done yet, it's coming for the fall, has received mixed receptions among some affordable housing advocates. Affordable housing advocates obviously being in favor of the tenant, right? I mean, landlords too, but tenancy more so. Well, why then would a rent freeze be something that would upset a tenant advocacy group? Like, why would that be the case? And Ryan also had a comment, and this is kind of what spurred on that conversation. He said this, and I think it's a wonderful point. Rent freeze is simply the government changing the channel away from having to discuss eviction moratoriums. Now the conversation has turned to freezing rents for an already reliving rental market. This is much less painful for landlords than the moratorium. Isn't it curious? I find it so curious. Is it a coincidence, if I were to think about it, that the rent rates are going back up in our city at the exact same time that the rental eviction ends? That the government has removed its grip from the necks of local landlords. Is that a coincidence? I think not. No. And this is why I think you're going to see prices continue to go up as things get loosened. And it's also a sleight of hand. And this is why I love this point. And it's changing your attention away from the evictions. And instead, let's focus on freezing rents. On rent freeze. Look at, we're serving you in a new way. Well, I saw a Twitter post that came out a couple days ago from XELAN. It's a real estate based Twitter post, and this is what they say. Ontario is planning to implement a rent freeze. Generally speaking, it's a nothing burger because vacancies are high, and it's very unlikely that vacancies go below neutral levels even in 2021. It will allow renters to save $19 a month on average, though, based on my modeling. What I love about this post is he maps out over time the increase in the rate, and what you realize very quickly is in the last few years we have seen exceptional growth in prices, increasing prices for rental rates. And this chart paints a clear picture that all that's happening with this rent freeze and all that's happening with the rates that have come down recently is it's bringing it back down to normal prices. That's all that's happening, guys. It seems like a huge influx up, a huge influx down. It's knocking out the people that maybe were getting a little overconfident in our market, but we are on a trajectory that is constant if you look in the long term, and recognize that. Recognize long term, if you're calling for long-term rental rate declines, you are heavily going against the norms that we've experienced in this chart all the way back to 1990. 1990. So there you go. I know I expected rental rates to drop, and you guys, if you've been listening, I've been calling it for weeks, and you know that. But now the numbers finally prove it, just like the university being created in a joint venture between the Iranians and the Italians. Ayatollah, oh my God, I wrote it down. I can't even say the word. Blow the punchline. Ayatollah you. Okay, moving on. Ayatollah you, because Iranian, Italian. Okay, here we go. So before we move on from this topic, I saw another article from CTV News, which I thought was hilarious. This idea of incentives. And we've talked about incentives before. And here are some of the incentives coming out of BC and out of Ontario, just to name a few. We got discounted rents, we got waived security deposits, we got free parking, we got free storage or free utilities for the first year of the tenancies. And we're also seeing, as part of this, Airbnb units converting over to long-term mix. Plus, now we know that we have the Airbnbs are going to be pretty much choked out entering the new year because they need to pay 4% tax, the MAT tax. And as that happens, you're going to see more enter the long term. So all of these things are factors playing in, and just some interesting things to think about. But here's a fun point. Speaking of the tenancy groups, so there's a tenant group in BC that made an interesting point here. Listen to this. The Nonprofit Housing Association is concerned that larger institutional investors could capitalize on the pandemic and snap up rental properties, potentially at lower prices, said Clifford. Quote, you need to have some sort of public authority providing funds to kind of help compete with some of these bigger private institutional players in the real estate market. Isn't it fascinating that we were so quick to jump on the landlords and say we need a ban on evictions, really standing for more than enough minutes on the necks of landlords locally? Maybe that's a bad analogy, right? But all of a sudden we're realizing what you're doing is you're scaring the small-time investor. You're throwing, which is a great opportunity if you're ready to buy up, including these high net worth institutions that we see is happening. And they're going to buy it up and they're going to monopolize. There's going to be less available units and they're going to monopolize the market. And do you think that's going to help your prices? Well, the tenant groups also recognize this is a problem. You've screwed the small investors and now renters are going to pay for it. Thank you, government intervention. Just watch. Just watch. Another fun fact, I saw another post that came on Twitter. Condo insurance premiums finally arrived to the GTA, premium increases. And here's someone that posts, Alan Casey, a few days back, experiences budgets are tight and insurance renewals. This is coming from a condo director. They're saying it's expected to increase by 20 to 60%, the condo insurance premiums. And they're saying that there's less healthy reserve funds to generate capital calls and expect increases above inflation. So you're going to have some increases, which is, again, making it difficult for local small-time investors. Some fun and interesting things to think about, guys. We should be thinking about this, and I know a lot of you guys are. That's why you're on our channel. That's why I love you. So how does this impact prices? Because we went deep there into rentals, but what is this going to mean? Well, according to a report from lowestrates.ca, the deferrals that come in September could trigger the real estate decline. I want us to be very careful of saying, because yes, I do believe evictions. You guys know one of my biggest things I'm watching right now is evictions and tenants, right? Tenants and this whole eviction crisis. But please, please, please don't get me wrong. Recognize that there is a ginormous backlog right now at the LTB, a huge backlog. Guys, I don't know how long it's going to take, but it's going to take months for sure. So it's not going to be instant. We're going to see this play out over the coming months, and it's going to come to fruition most likely in the winter time. Just recognize it's going to be delayed impact. But I got a post from Baseline. Speaking of prices, you guys know I was calling for actually July to be the peak. I actually made a video called "This is the best month." Like, this is going to be the top. That's the end, guys. That's the end. And I believed it was for both sales and prices. Well, it turns out I'm only half right, because when we look at the stats that are coming out from House Sigma, we're waiting still for Treb. So this is kind of unofficial stats. It would appear, based on what Baseline is saying, that there's lower sales than July, this month in August, but higher than June. So it's come down slightly, but that the average price is slightly higher than July. So as far as the amount of activity, maybe this is what I've really been mapping, the activity itself went down. Somehow prices have still gone up, really just incrementally. But we're going to be watching the Treb stats later this week. Make sure you hit the subscribe, bell for notifications, whatever the heck you got to do to stay in the loop, because when there's an opportunity to snatch something up, I'm going to tell you, but I'm not allowed to give advice because I don't want to lose my license. And I know we're really jumping around here, guys, but I want to move on. I want to move on to our next question here. So looking at Canada's housing market, Canada condos. So we know in Toronto, there's going to, as I've said, there's going to be a buying opportunity as we round into the winter months. And people have kind of established, and we'll get to how I think people are starting to establish where they want to be. The people who want to run from the city have run from the city. That's my point. And I'm going to show you where I'm seeing that. So what's happening now is we have a tightness in our condo market. Well, how does that look compared to the rest of our glorious country? According to the Canadian Real Estate Association, only 5 major markets saw condo prices hit a new peak in July. Over 2/3 of Canada's major markets haven't seen a peak since the beginning of the pandemic. Canadian condo prices. So on average, according to the Korea benchmark price, on average, we are up in July 6.37% from the same time last year. And this price is actually down 0.31 from the peak it reached in April. So we're down since April, but most are up since last year. Hopefully that makes sense. But there's only 5 markets that have overshot that April spring pricing. And these are the cities. And I want to make sure we recognize that most of them, actually all but one, are in Ontario. Here we go. Ottawa, Niagara, Guelph, Montreal, and Oakville. When we look at Ottawa, they had a typical condo price increase of 22%. That's your high end. And it saw the, quote, smallest was in Oakville. Sorry, Ottawa was up 22%. Oakville was up 10.2% from last year. So anywhere from 10 to 22% in these markets. Still a wonderful return. 5 condos market peaked this year, including Toronto. So when we look at which markets are doing really well, Barrie peaked in May, and it's down from its peak 2.53%. Hamilton is down from its peak at 2.2. Toronto's down from its peak at 1.4. So when we look at Toronto, if I can just kind of jump in for a second, prices have come down since earlier this year, since earlier during COVID. However, they're still pretty good. Like, they're very high. They're definitely up year over year by quite a bit. And Victoria is down 1.02. But let's consider the rest of Canada from their highs. Because Toronto, from its highs in the condo space, is down 1.4%. Not that bad. Still a deal, but not that much of a deal. When we compare it against other cities, let me give you a few. Regina, down from its highest point, 29.05%. Quebec, down from its highest point, 6.72%. Calgary, down 17.36%. Edmonton, down 30%. Saskatoon, down 20.65%. And these, a lot of them, like for example, Edmonton saw its highest price back in 2007. It hasn't recovered. So yes, we have an opportunity for condo purchases in Toronto, a relative discount when it compares to the rest of our country. If you're really looking for the cheapest price, maybe this isn't the place for you. But it also goes to show the strength of our local marketplace. Yes, a deal is coming. No, we don't have it that bad when you compare it against the rest of our country. Not everyone, though, can be convinced to jump in when prices are low. Right? That's life. Not everybody's there. Not everybody jumped in early on during COVID, but maybe the numbers, they're not even convincing enough to you. Even if I show you all these numbers, perhaps you're the person that wants to join the debating team in university, but gets talked out of it. That's natural selection, baby. All right. Before we jump into our last topic here, I want to share with you a few other hot topics that I'm kind of seeing in our news. A very interesting article came out of BlogTO talking about garages. There was a garage for sale converted into a house, legitimately a garage. It had a garage door on it. But it went up, though. It was automatic. Listed for $1 million. $1 million. So they talk about how just a few weeks ago we saw a tiny home listed for $1 million and sold for $808,000. We kind of highlighted that in our podcast. Well, this home is a 2-bedroom, quote, loft in Corktown. It's listed for $990,000, and the home is billed as, quote, loft style living at ground level in downtown Toronto, and an artist's dream come true. Maybe that is where the professor from OCAD lived. But it looks to be a converted garage with a functioning roll-up door. So people are scratching their head like, why are you selling a $1 million garage? Like, why are people paying for that? Well, maybe it's not the garage they're after. Need I remind you guys the opportunity that exists with laneway or carriage housing. And that is what I believe this is. Not just living in a garage. It's the space. We talked about this, right? That property itself could cost anywhere from $500,000 to $1 million. We said it. And now we're seeing a property that's been built in that space. A garage is a unit now, but that lot itself is worth $1 million. There's the proof in the pudding. All right, here we go. Next topic for you is this idea of an election. And I don't want to jump too much into the politics of it because although I have my perspective on what's going on, I believe it's completely political. Funny enough, the politics is completely political. But we're keeping our eye on it because if in fact we do have a fall election, we need to know, right? Because bringing an election earlier means further spending. That's the way I see it, which is generally good for raising prices. But I'm keeping my eye, and which tool you vote for is up to you. Just because they're running our country, that doesn't mean they're smarter than us, okay? They clearly, with the way that they're spending our tax dollars, they're just as nutty, and it just so happens that they're professors in universities. They're academias. An academia nut. Which is actually hilarious because Trudeau was a teacher, as we all link it back together. Okay, so here we go. TheStar.com, talking about this idea of second wave. It's just really... Whether we get a second wave or not is irrelevant. The perspective or the opinion we will have a second wave creates a fear that affects our market. Recognize that the fear of a second wave is enough to affect our marketplace. The psychology, right? And when we look at it, around 83% of Ontario surveys said they're worried that social distancing and lockdown measures are being relaxed too quickly as schools and businesses open again. And they say 73% say they're becoming more wary of people's ability to properly follow protocols that curb the spread of the illness. So people are cautious, and we've seen a recent uptick in COVID cases. And I don't think people are going to be traveling as long as this remains a problem or a perceived problem. Kids out there, they be getting acceptance letters from the International Origami University this month, but they aren't sure what to make of it. I think I got to stay home or do it online, right? Now, I did kind of highlight this idea of working from home. And where am I getting this opinion or this thought? Well, Scott Ingram on Twitter said this. A thread on, quote, exodus to suburbs and WFH. This is in the States. But before I say the stats for the United States, recognize that they're in a very similar scenario. We have real estate prices going through the roof and people leaving in droves the main cities. Well, they did a survey finding suburbanites are just as likely to be considering new residents as city dwellers. So when we look at, are you happy with the area you live in? The point here is that it's generally flat. Like people seem, because when we look at the people in the city, there's 71% say that they're thinking about relocating. So would you consider relocating? 71% said yes. In the suburbs, 71% said yes. And in the rural areas, 78% said yes. Anyways, this point and how he's kind of summarized it is it doesn't seem as though people are going to be running, because when we look at another survey, only 3% to 5% are going to permanently work from home, because they're asking them about, based on their income, whether or not they plan on working from home. And it would seem that most people are going to be they're eventually going to be going back to work. So the combination of people going back to work and already having left and being content with where they are and having relocated tells us that the mass exodus is behind us. That's kind of the point I wanted to share here. And he said this, he summarized it. I personally suspect that a lot of people that were already considering moving have already shot their bolt, like just moving up their timelines. If true, is kind of the opposite effect of pent-up demand. It's more like pantry loading, like how people bought 8 months of toilet paper. Everyone jumped. There was a sudden shock, right? Everyone jumped out at the same time, but eventually things will go back to normal, and the working from home thing is going to be short-lived. That's an opinion. That is an opinion from Scott Ingram, and that tends to line up with what my thoughts are too. But obviously, this comes from the States. And do you know what the average University of Alabama student got on their SAT test? Drool. So we're going to try to keep it Canadian, and we're going to jump over and talking about this idea of our dependence on real estate. So our final topic here, and I'm going to show you why, although better dwelling would have you convinced in this article title called Canada's Drop in GDP Made the Economy Even More Dependent on Real Estate, Well, I'm going to show you why that's no different than past years, just like university is similar to high school, to a degree. Canada's real estate industry has seen a smaller impact than the general economy during the pandemic. StatsCan data shows residential investments fell in Q2 2020. The drop was smaller than the 1 GDP made, though, meaning the economic dependency on real estate grew, at least for the next few months. So here's what they're saying. GDP is down. But GDP is down far faster than real estate is down, and therefore we are now more reliant on real estate. That's the whole argument here. So when they talk about Canadian real estate investment drops, they say it dropped 11%, and this is according small increase on the quarter, but is down from last year. So we're seeing kind of fluctuations, but really we see it's up 0.187 from the previous quarter and is 11.36% compared to the same quarter last year. So again, residential real estate is down 11.36. This is kind of the GDP of real estate, if you will. Doesn't include everything, but includes a lot. However, when we look at the GDP of the country, they say it's down annually 14.7%. So naturally, because real estate has gone down less than the GDP, they say this: since the drop for GDP was larger than the decline for residential investment, the economy became more dependent on real estate. I believe, and as the stats are now showing too, real estate has become kind of an anchor to reestablish ourselves, to take off and launch the GDP once again. But what I'm hearing here, those numbers are quite close. So maybe, actually, although they're setting out in this argument to convince me that we are far too heavily reliant on real estate, it actually did the exact opposite and made me realize that there isn't that much fluctuation. In fact, it seems to line up with past years. As the economy returns to normal, the ratio of residential investment as a percent of GDP should continue its downtrend. In the meantime, however, the country is getting a little more dependent on real estate. I want to read this other point that they said and why they kind of summarize it and screwed their own point. Canadian residential investment is lower in dollar terms, but not dropping nearly as fast as GDP. This is printing a short-term increase in the dependency ratio. However, many of the factors that drag GDP lower in Q2 are being considered temporary. And they actually say that although we're up, they say it's reached 7.48%, this kind of percentage change, like the way you compare them. In 2016 in Q2, it was actually at 8.69. So we're not even at a high here. But they're saying on a longer horizon, there's actually a downtrend. So again, although they set up to convince you we are way too heavily involved in real estate, and therefore, I mean, you know this is a bubble argument, therefore it's a bubble. It's a real estate bubble. Well, actually, it's nowhere near it was in 2016, and it is generally a downtrend. So, burst that bubble. But people do trust real estate as a safe haven, and during inflationary times, of course, that's a great opportunity. GDP will rise and the percentage will go back, which is why I'm not all that concerned about this. So hopefully you guys learned some stuff as it relates to real estate, and I'm just going to leave it off here. I got such a good amount of flack for my last podcast. I did a joke about cannibalism, and obviously people aren't okay with that. So let's do one more in the spirit of stimulating the comments. What do you call a cannibal that works in a university? Hannibal lecture. All right, we had some fun, guys. Make sure you hit the subscribe button, leave us a like. Hopefully you learned some stuff. If you have any topics you want us to include in our next podcast, let me know. In the meantime, we're going to be keeping our eyes out for the TREB stats and bringing that up to speed with you guys. I hope you have a wonderful day. Happy Monday. Take care and keep it real.